So this is the really concise title that I came up with for my talk, right? Coming in for a soft landing, I think, whatever that means. And as much as that seems like I didn't put any thought into it, I actually kind of did. So let's get into this. I don't need to, it's no surprise to any of you that the main thing right now is not knowing, right? So confusion reigns. I think what I like to point to in that conversation is how disparate the hard and soft data are right now, and have been for quite some time, right? A lot of the hard data actually looks pretty good. And what I have here is the Philadelphia Non-Manufacturing Survey. So that has a sentiment component, which is the questions along the top, and then it has a bunch of hard data in it as well, which is the things that are in the next section of that table. And as you can see, the sentiment reading is -16, which is a very negative number, slightly improved from the previous reading of negative almost 23, but still really bad. The outlook from those surveyed was very pessimistic. But then you look at the hard data and everything actually looks pretty good. This is just an example, right? This is a capture of this ridiculous divide that we have right now between sentiment and data. And I also have like this PMI. You can see that that's going up. The GDP now suggests that the blue chip estimate is way below what the actual GDP growth is. So this is the whole thing. Like sentiment remains very recession wary. And so everyone's very cautious. Liquidity in the markets is very low. Well, AI is changing that a bit, but in general, liquidity in the markets, volumes are very low, sentiment is terrible, and yet things are going along just fine. In terms of, I say that, not, a lot of the data that comes in about the monthly numbers looks good. A lot of the pattern-based indicators have been flashing red for some time. Of course, yield curves is one of the key ones there. We've been having this conversation for half a year or more already. Tavi Costa of Crescat Capital did a really interesting analysis, I thought, where he was like, okay, sure, yield curves reliably invert before recessions, but that doesn't actually help us with timing. So he tried to figure out if there was a way to look at yield curves to see if it did, in a way that did help with timing. And what he did was look at all of the different yield curves, and he determined from historical occurrences that recessions reliably start immediately, like within 6 months, when 70% of the yield curves in the US invert. And guess what? We are there. So we do have pattern-based indicators that are very recessionary, but a lot of the just data points are doing just fine. I don't need to tell anyone here that recessions are good for gold. If that's the direction that we're going, then okay. This is a continuation of that analysis that Tavi Costa did. And he just looked at the gold to S&P ratio after that 70% of yield curves inverted moment. And he can show with the green line where we are now. The blue line are the best two outlays from that moment, and the yellow are the rest of the outlays from that moment since 1970. And yes, recessions are good for gold. We know that. But is that where we're going? This hard, soft data discord means that we don't really know, right? Okay, so that has a lot of people saying, okay, so soft landing, that's where we're going. We're going to a soft landing. But the more I've been thinking about that, soft landing is just a meaningless term, right? Because all it really does is describe where we are right now. Things are fine. But it doesn't help us know where we're going. And a term is not useful unless it tells us where we're going, right? I know where we are right now. We're confused and things look okay, but we're worried. So where are we going? I think that in this soft landing setup that we're in, there are two paths forward. And what really matters is which of these paths that we take. And the difference is inflation, right? The perfect soft landing is inflation keeps falling. So this growth that we're seeing, these reasonably good numbers sustain, but inflation comes down. And that means everything can just calm down. We can stop being so obsessed with rates. We can stop being obsessed with inflation. The risk caution can come down. Investors can start thinking about growth and investing based on growth, which is what we need for a base metals market, for example. That's what happens if inflation comes down within this soft landing setup. But the other possibility is that inflation doesn't continue to come down. It either flattens out and stays where it is at 5%, which is still too high, or it starts to rise again, which is certainly, of course, a risk when the economy is chugging along as it seems to be. And that is just more of the same, right? So we have either the perfection route or we're just stuck in this setup for longer. And that's where we are. And the thing about the more of the same is that it just carries on until we either get to the inevitable endpoints that we've been discussing for all of this time, which is recession or perfection. So it's kind of funny to be so black and white, but I think that that's where we are, and all really hinges on inflation. Now, for the gold investors in the audience, as there might be one or two of them out there, either of those setups, I think, work well for gold. So perfection, I don't think it's highly likely that we end up with inflation continuing to decline nicely while the economy speeds up and we get this perfect landing. It's possible. If that does happen, gold doesn't get standout attention, but I think it does get carried along with an overall metals bull market, which would start if and when investors start to focus on economic growth again, right? Gold doesn't have the same fundamental drivers in a economic growth environment that base metals have, but it almost always gets carried along in a metals bull market, which is really helpful. So I think gold works in the perfect soft landing scenario. Gold also certainly works in the more of the same. Gold has been doing very well. Sure, in the last few weeks it's softened a bit, but 2023 has been a fine year for the price of gold, and so I think gold also works well in this more of the same environment. And it probably does even better if inflation starts to rise again, as it is a hedge for all of that. Of course, in the more of the same environment, people continue to not care about base metals. Sigh. So inflation is the thing. It is dropping right now. I don't think anyone can argue that right now it's dropping, but the questions that remain unanswered is, will it keep falling? And will it get low enough to create confidence? And inherent in that question is another question. What is low enough? The chart on the bottom there, which is from Incrementum, they just released yesterday, I think they just put out their latest In Gold We Trust report, which always has lots of really interesting tables in it. That's just a chart that shows inflation in the US. And the green shaded thing shows what inflation year over year would have to average over the next decade if we want a decade's, or up until 2030, if we want inflation for the decade to average the Fed's goal of 2%. So it would have to average 1.2% until 2030 to get ourselves to the Fed's goal, which is 2%. So that's a thing, 1.2%. That's fairly far away from 5, which is where we are right now. If we actually wanted, if the Fed decided that it wanted to reach its 2% inflation goal over for sort of the 2020 to 2026 period, if it wanted it to average 2% in that time frame, we would have to have inflation of only 1.2% until year over year until 2026. So it doesn't seem super likely that those are going to happen. I just put that up there because the question is, what is low enough for the Fed to breathe, for investors to get confidence that the Fed is breathing, there's no more rate hikes, things can get back to a focus on growth? What is low enough? I don't know the answer, but that is the most important question right now, I think, when it comes to gold investors and base metal investors. Okay, so the debt ceiling. I'm not going to spend a lot of time talking about the debt ceiling because there's far too much conversation about the debt ceiling right now. News this morning is fairly positive about a resolution. No surprise, the markets have been betting that this will resolve, so I think that that's sort of par for the course. The part that I want to focus on is that the Treasury has not been issuing new treasuries for since January 1st. They realized that this ceiling was coming, and they're like, oh, we got to give the politicians as much time as possible to fight. So we will stop issuing new notes so that we don't hit this, so that we give them more time before we hit this ceiling. But then they have to play catch up, right? So once we get a debt deal, there will be a flood of new treasuries that hits the market. Usually in a 3-month period, you get something like $400 billion worth of new notes, maybe a bit more. And it looks like there'll be something like 3 times that in issuance of new treasuries over the 3 months following a debt deal. That is very significant. It's significant. It would be significant in any environment. I think it's particularly significant in an environment where emerging markets are doing what they can to buy fewer treasuries. And just in general, when you flood any market with supply, the price is going to go down. And with treasuries, that means the yield is going to go up. So that likely will drain liquidity from the stock market because money is very likely to chase yield. If yields are going to keep going up, and that's a reliable thing, versus a stock market where we don't know what's happening. That's what I started with, right? We don't know what's happening. It's likely that money is going to chase yield and go over there. If that does happen, it's likely that this chart that I've put an arrow on there would likely keep moving higher. So this is the GDX, gold miners, versus miners in general, and miners in general just being an indication of overall growth. And it's a nicely cyclical pattern, and it has turned up notably in 2023. And if the pattern continues, which it could well do if the flood of new treasuries pulls money over to chase yield instead of the stock market, then maybe we see another relative strength peak for gold miners versus other things sometime at the end of this year. Now, of course, big tech is the question here, I think. We had a good chunk of time there at the end of 2022 or all through 2022, I meant to say, where the big tech bubble had let out a good amount of air, right? The outperformance of big tech really stepped back, and smaller cap stocks, the performance started to match smaller cap stocks. In fact, they even lost more ground than smaller cap stocks in that crappy year of 2022. But since 2023 hit, we're right back to big tech everything. I mean, there's all kinds of crazy statistics out there about how, the top 10 stocks on the NASDAQ have accounted for 98% of the S&P's gains so far, like year to date. The outperformance or the outweight of these big tech stocks is really sort of hard to wrap your head around. They are pulling the market higher. Of course, now AI is back on that, and NVIDIA, I'm not sure how you're supposed to say that name. I read it a lot, but I've never actually said it out loud. I just realized standing in front of all of you. But anyways, it is adding to that setup, right? So that's it. That's an interesting wrench in the plan. We'll see what happens there. When I say for that we need, for gold miners to outperform other things, I think what we need is more gold equity investors. And I've taken this chart from my old boss, Marin Katuza, who charted here gold miner ETF fund flows. So that's the green bars. And the thing that's notable, I believe, is that since 2016, 2017, there's been basically no new money coming into the gold space, right? Money's been changing hands, sure, there's buying and selling, but there hasn't been a bunch of new money coming into the gold space since 2016 or 2017. And that's not great, right? If we want gold stocks to outperform, we need some new investors to come into the space. And that all goes back to the big picture. Sometimes I wonder when week after week I spend a whole bunch of time on macroeconomic analysis, I'm like, is this what I should be doing? And then I come to moments like this. Are there going to be new investors into the gold space? Well, that depends on a whole bunch of large economic questions. Like, will debt once again carrying cost, as in having interest rates of significance, will that shift investor interest back to fundamentals instead of speculation? We've been in a very spec-driven market for the last decade, right? So with interest rates having significance again, and likely to stay that way for quite a while, will that shift overall investor focus back to fundamentals? If so, that works for gold and gold mining stocks. It probably also works for base metals once we get back to some sort of growth environment. Will this big tech bubble ever pop? What is going to happen with that? Is there going to be a recession? And then there's geopolitics. And I don't love to talk about geopolitics. Often at a gold conference, when geopolitics is discussed, it's discussed in the context of like a particular event, a clash or some moment that floods attention to gold for a short period of time. That's not actually what I'm referring to here. What I'm referring to is central banks and sort of this fund. I'm not jumping on the de-dollarization train. That became a word du jour in the last few months, as it does every few years. Sure, the US dollar will, over time, weaken slowly as the reserve currency of the world, but it takes a very long time for those processes to happen. What is happening right now is that de-globalization is boosting gold. It's part of the de-dollarization process, but I'm not going to focus on that. I'm going to focus on de-globalization being the BRICS are the BRICS Plus. There's like 19 other countries that want to officially become part of that BRICS alliance, and they are interested in ensuring that there are trading mechanisms that are outside of the dollar, and having gold is a big part of that. So guess what? Central bank gold buying has been very significant in the last decade, but it's ramping up right now. So on the left is central bank gold purchases in tons, and you can see that as of a decade ago, it shifted to buying from selling. Okay. What I think is really interesting is the chart on the right, which is central bank gold demand reported versus unreported. So the blue is tons that central banks bought, and we know which banks bought them. So banks have stepped forward and said, we bought this many tons this year, and that goes on the chart in blue. The part of the chart that's gold is central bank buying that the World Gold Council knows about, but the Gold Council will never front run a central bank. They won't disclose that a central bank bought before that bank says it themselves. So there's a huge amount of central gold bank buying that is undisclosed. So there's central banks around the world that are just quietly but significantly accumulating gold. This isn't the kind of thing that sparks a rally in the gold equities by any means, but it does create a very strong base of support for gold. And I don't think that that's a base of support that is going to go away in any way over the next little while. Okay. That was a lot of different things that I tried to cram into a short period. I have a few comments on stock thoughts just before I wrap up here. The gold equity markets have been divided for a while now. So we have the haves, stocks that have attention and have price momentum, or at least have price stability. They can raise capital, they can make progress. It's a small group, but there certainly are stocks that fit that bill. There, you call them the have stocks, the top tier stocks, whatever word you want to use. The rest are all the have-not stocks, and it's quite a distinct division, right? The have-not stocks can't get attention. Their share prices reflect that. And because their share prices reflect that, they can't raise money, and if they can't raise money, they can't make progress, and so they end up stuck down there. While I was away on my Disney cruise, the haves group seems to have gotten slashed in half. Hopefully that turns itself around. It was bad out there in terms of a small select group working and a lot not working. I think it got worse in the last 2 weeks. If gold steps forward again after a debt deal, which is likely, I think it would be it could work well to look for companies that were just kicked out of the haves group. I have a bunch of companies in my portfolio that were doing really just nicely through 2023. They were just climbing, doing their thing, climbing, and then in the last 2 weeks they dropped back down. I think there's a good chance for some rebound from that drop once we get through this debt deal crisis and gold starts to perform again after that. So I've put some examples there of the stocks in my portfolio that I think have gone through precisely that step down in the last little while and that I think might rebound some after a debt deal. I also think it would be worth looking for companies that are in that top tier group that have been doing well, that have had momentum or price stability, but that put out significant news in the last 2 weeks and got nothing for it. And Banyan, Tara's up here and she'll come up and speak soon. Banyan is certainly one of those, put out a very significant new resource, got no love for it, not because of the news itself, but because of the context of the market. Two other stock thoughts. Stocks are getting hammered when they need to finance. It's a cruel irony because often the hammering is coming from funds that want to buy more of the stock. So the fund owns the stock, they realize it needs to finance, they sell in the market to push the share price down so that the financing happens cheaper so the fund can reload and get warrants at a lower price and hopefully do better for itself. So it's a cruel irony, it's unfortunate. It's an opportunity for investors if you believe that they can raise the money and your investment thesis for that stock is intact. There's been a lot of examples of this lately. So financing is a real risk out there, but also potentially an opportunity. And of course, base metal stocks are just on the struggle bus. Recession risk, growth, China, these are all the reasons that base metal stocks just can't get any love and won't, I don't think, until we get to a period where people are paying attention to, are refocused on economic growth. Just as a last comment, I'm speaking too long, which I rarely do, but anyways, what is the gold bear case? So I've listed sort of the scenarios here that I think are laid out before us. Which one of these is bad for gold? I think they all work, right? So a recession, gold works in a recession. A perfect soft landing, I think gold gets carried along with a base metals bull market. A more of the same soft landing, gold's been doing well so far, so I don't see a reason to believe that it would suddenly do badly in a more of the same type environment. The first two work for stocks and gold itself. The third one works for gold and the have stocks, unless it's a week that I'm away on a Disney cruise. And then all of those scenarios, I think, continue to get significant baseload support from central banks, which is something that will persist for a while.